saying in markets that they don't ring a bell at the top. When you're in a bubble, you'll probably know that you're in a bubble of some sort, but it's hard to tell when it's going to finally pop and go away because each new event seems more absurd than the last, and yet they keep compiling. Only in hindsight do you see the one that finally marks where the fury has overrun itself and where the markets calm down. Last week in the markets, we might have seen a bell-ringing moment of sorts. But I'm actually more interested in evidence of a past bubble that has reached a new bottom and what it might mean for that sector and what we might learn from it for current bubbles, but also for markets in general. That's what we're going to talk about today in the long and the short of the markets. My name is Daniel. It's February 18th, 2024. Subscribe to this channel to get more of these videos, and let's get started with today's topic. The bell ringing I'm talking about is related to the AI hype that's been running rampant in markets basically since last May. The company I'm talking about is Supermicro, a company that is growing its revenue and earnings quite fast, but has seen its stock triple in 2023 and then more than triple in the first 6 weeks of 2024. Even though Supermicro, which provides server and computer technology services to companies, including companies that are involved in AI, benefits from these trends and is indeed growing, this is just the pure stuff of meme stocks. Supermicro became the way to play AI. Its stock went crazy, reaching a height of $1,000 a share versus where it started 2023 at $82 a share. It then sold off 20% on Friday, dropping down to $800. That's a pretty toppy moment. But on the other hand, we got some bottomy moments or some low notes from a former hyped sector. You might recall the excitement around SaaS companies, software as a service companies, specifically newer types of companies that were very focused. Zoom, Docusign, Twilio, those sorts of companies that were an SaaS 2.0 type of company that were meant to be the next big thing, became the next big thing over the pandemic, exploded in share price, popularity, awareness, and all have suffered greatly. Those companies have been struggling, their stocks have been struggling, as each of them are quite below where they started 2020 before we ever heard of the pandemic. Twilio is 43% below that share price. Docusign is 25 or 30% below that share price. And Zoom is 10% below that share price from the start of 2020. This despite the fact that each of their businesses have more than tripled in revenue since that time. What's going on here? Let's start with Docusign, which is the healthiest of the three companies I just mentioned on a financial basis, at least arguably. It only trades for 13.6 times free cash flow from the last 12 months. It's growing relatively fast compared to its peers, 9% in revenue growth this year, then expected to be about 6 and 8% in the next 2 years. I'm rounding up in those cases. On paper, Docusign seems to have a healthy, solid, growing business at a reasonable valuation. What's not to like? I mentioned the share price, and the company appeared to feel this way too because it recently put itself up for sale. It talked with private equity companies about the possibility of buying Docusign and going off the private market. According to reports, the price of shares was in those discussions was somewhere around $60 a share, which would be higher than Docusign's traded for the last 9 to 10 months, but lower than Docusign has traded any time before that, including, like I said, start of 2020. It would have been about 25% lower than where it started 2020. So even though that might be the right option for Docusign to take in the near and medium-term future, it would also be a huge disappointment for its shareholders. Regardless, Docusign decided not to go forward with that or never received an offer sufficient. Those talks have failed, and Docusign instead announced a new round of layoffs, letting go of 6% of its employees as it prepares to continue its independent existence. While Docusign, which we all know is embedded in our day-to-day lives through e-signatures and its workflow and various things that we do, is one story, Twilio is a less financially healthy story. Twilio, which is a messaging company that provides the technology to underlie a lot of the messages we receive in different platforms, that second factor authentication and so on. It is positive free cash flow, but solely because of share-based compensation. Negative EBITDA, even when you add back an impairment that it had last year. And while it's growing faster than its peers, 9% last year, looking to be continuing in the 9, 10, 11% range for a while, its growth is less valuable because its gross profits are a lot lower. Twilio's gross profit last year was 49.2% of its business, as compared to a Docusign, for example, which was 79.2% for the first 9 months of its fiscal year. These software as a service companies tend to be around 80% gross margin. Twilio way out of that range, which makes Twilio's recent news even more interesting. It had already replaced its founder and CEO with a new CEO in January of this year. And then when it announced earnings last week, Twilio said, we're putting our segment under review. This is interesting because Segment was a company that Twilio bought during the pandemic, during the peak of the pandemic, for a stated $3.2 billion. Since it was bought in shares and not in cash, if I'm not mistaken, the actual value of that purchase should be about $640 million, which is a little bit better. But Twilio wrote off $285 million worth of that company off of its balance sheet, saying we can't really justify keeping that as that value on our books. It's a big deal because Segment was meant to be Twilio's play to continue to climb the value chain and to sell higher value services. While they haven't precisely disclosed, as far as I've seen, what the gross profits is for this unit until they release their 10K, which will come out relatively soon, it should again be around that 80%. Twilio giving up on this 80% gross margin business, which it seems like they're doing, having put it under this operational review, would be a big move and a surprising one in the context of what the business needs to do. But then again, that business only grew 4% in Q4 and 7% for the entire of 2023. Not a fast growing business, and so even with that gross profit, maybe it's not worth it to Twilio over the long term. The last company I want to talk about is actually not Zoom. I'll come back to them at the end. It's Dropbox. Dropbox was one of the first SaaS 2.0 companies to come to prominence and then to come to public markets. It came public earlier than these other companies and became old news earlier than these other companies. It was already kind of blasé when the pandemic hit. Dropbox indeed is the first company in this cohort that I've talked about that has its shares trading higher than it did at the start of 2020. But even with that, the file sharing service company's latest news is not great. The company announced earnings last Thursday and on Friday sold off 23%. That's a lot. Why? Dropbox said, we don't expect to grow more than 2% in revenue next year, even though their free cash flow will grow more. And also for the first time, the scarier bit, they said that our annual recurring revenue and our total paying users both dropped in the fourth quarter of 2023. Those are two key factors into a business's underlying growth. And if those are going negative, that's a bad sign for how the business is doing as a whole. That spooked people, and that suggested, as Bank of America's analyst said, that the bull thesis has played out and that we're at an end for the Dropbox story. What brings these companies together besides that they're in a similar sector? I find three themes that we can tie that will bring these companies together and their woes and their problems, and then will point us towards what we can expect when we talk about Zoom's earnings report that's coming a week from now. If you just look at Twilio's analyst estimates for earnings for the next 3 years, Twilio's valuation looks pretty reasonable. 22 times earnings for 2024, for example, and then lower multiples for the years ahead as Twilio is expected to grow its earnings. Not so bad. And yet Twilio has negative EBITDA. That's earnings before interest, taxes, depreciation, and amortization. As the late, great Charlie Munger called it, bullshit earnings. If Twilio looks negative on the most favorable lens for profitability, what's going on? Simply share-based compensation. These companies are generating cash from their business, but they're doing so in part or in a large part because they're paying their employees in shares in the company. Totally reasonable practice, but that needs to be factored in and isn't always. Docusign, for example, had $750 million in free cash flow over their last 12 reported months, yet have paid out $600 million in share-based compensation. Zoom has $1.3 billion in free cash flow over their last 12 reported months and $1.3 billion in share-based compensation. Dropbox has $633 million in free cash flow and $338 million in share-based compensation. This all matters and it all affects the profitability. I'm not one to tut-tut or get puritanical about this concept, to say that they're stealing from us as the shareholders or anything else about the companies. Share-based compensation is a totally legitimate practice and important part of the cost of running a business, but is a cost of running a business. And it's one that we do have to count and we do have to think about when we're valuing a company and thinking about what its success might look like. For a long time, the standard was this is how we do it in Silicon Valley, and we're seeing increasingly that doesn't hold weight on Wall Street. The tech sector has been in a jobs recession since at least early 2023, if not dating back to the 2022 bear market. This impinges on these companies' businesses in several ways. Just to go back to share-based compensation, if their share price is lower, they have to pay out more shares to get the same value to their employees. That's a pressure. But more specifically, if companies all the way down from the Googles and the Alphabets and the Metas and the Microsofts of the world are laying off employees down to smaller companies, that means fewer seats for a Docusign subscription. It means fewer members in a Dropbox group plan. It means fewer people who need to pay for Zoom at the company to conduct remote meetings. All of this weighs on a business. And then even more from a mindset perspective, as these companies are going through their years of efficiency, they're going to study every expense. And while it used to be taken for granted that you need this, that, and the other subscription, now companies are looking for what can be removed, what is duplicative, what is unnecessary, what can we live without or with fewer seats. All of this puts more pressure on the revenue growth lines of these businesses, which leads us to our last important point. The knock on Dropbox has always been that who's going to pay for another service when I can use Google Drive or Apple Cloud or Microsoft 365? Why do I need my own vendor for storing data, essentially? And yet, Dropbox has trundled along with relatively slow growth for this sector, but consistent growth and good profitability compared to a lot of its peers. That same knock has been added to the Docusign story as compared to Adobe Sign, for example. And Zoom epitomizes a different problem, which is what if you're doing so well that you attract the giants so that they start building their own products? Well, I can say for a fact that Microsoft Teams and Google Meet are inferior products to Zoom. If you're looking to be efficient and you're looking for what's easier, you may end up going with those products that are either bundled or cheap or free as compared to paying for a Zoom exclusive subscription. But this problem gets even deeper than that because there are people out there who don't want to just rely on the major companies. At some point, there's a fear of monopoly or whatever else, and people want alternative vendors and alternative quality. But when you have a Zoom, for example, which is expanding into call centers and into contact centers, which is a very logical expansion, but then it's also trying to build out these AI-powered tools that have to do with summarizing calls or then even Zoom chat, then all of a sudden Zoom is treading on Slack's turf. You have Dropbox, which is looking for how it can grow using AI-powered stuff, but then also Dropbox signatures, which treads on Docusign's turf. Twilio, in its effort to buy Segment, was trying to barge in on Salesforce.com's turf, trying to get up the value chain where it could do better. You go into the project management space with companies like Atlassian and Monday.com and Asana, and they're all crowded and competing with each other. And you get to a point where there's nowhere for these companies to grow without taking at the expense of another company. My podcast co-host Akram's Razor wrote a great work in 2019 called Once Upon a Time in Tech. very long, it's very good, it's very much worth reading. And I won't try to paraphrase it too wrongly here or say anything out of line. But my biggest takeaway from it, or one of the things that sticks with me the most, was that all of these point product companies, all of these companies that are focused on a dedicated problem and how we can solve it, and nailing in and zeroing in, we're going to get to a point where they were going to be bumping into each other, where there was no room for you to continue to grow into your valuation, into what you're trying to do, without needing to expand what you're doing into something that a peer of yours is already doing. And once you start to conflict, all this collaboration stuff between apps is going to go away, and it's going to be harder to grow because everybody's going to figure out what they're locked into, who they like the most, and they're going to make decisions about that. This is a challenge for these businesses that they're all clearly facing now. How can I continue to grow? How can I continue to make more of my value for my customers while still making new sales and keeping my customers? And that's the challenge. Because if they're not able to do this, then we go back to the old thing that Steve Jobs famously said to Dropbox's founder, Drew Houston, which is that your company is not a product, it's a feature. It's just a feature. It can't stand on its own as a company. To some degree, the pandemic pushed back this reckoning as we accelerated our pace in going to these sorts of products. But now, as we're more normalized in our environment, this is coming to bear again, and it's making these companies' lives that much more difficult. This is on my mind because I own Dropbox shares. I'd sold some of those shares earlier this year, and I said to myself, okay, I'm probably closer to selling than buying, but I want to see how this quarter goes before I sell the shares fully. Turns out to have been a mistake. I got new information and it wasn't great. Even if I think the sell-off is a little overdone, the fact is the Bank of America analyst's argument is fair. Both thesis has played out, and now I'm sitting here waiting for AI saviors if I'm continuing to own the shares. I had been eyeing Zoom as a potential replacement for Dropbox. Exposure to software, another company with a great product, a powerful position, a third of its market cap in cash, giving it a lot of flexibility and financial security. And there's something there. They have a well-respected management team, and their contact center move is one of the more logical verticals to move into, one of the logical turfs for it to tread on. And it would seem that Zoom could eat a lot of other companies' lunch in that field. Thematic investing has been really popular in markets in recent years. It's something that Kathy Wood of ARK Investment popularized with her approach. Something that's gotten a lot of attention and a lot of focus. And obviously it's done well for her at different times, at least in building her reputation and notoriety. It makes sense too. If you're fishing in the right ponds, you catch the big fish. It's a logic that works. Until it doesn't. Until the theme changes. Until the theme gets played out. Evidently, yesterday's theme, which is the digitalization of our workflow, the move of everything to the cloud, microservices, SaaS, all of these point products that are going to make our lives better, that has faded. It's clear that that theme has played out, and whether or not those companies will reemerge or become value plays or anything else remains to be seen. But that is the way of all themes. No theme runs forever, except that earnings is what matters, and you look for companies that can grow their earnings over time. Which is interesting because we talked about super microcomputer earlier, and this week we will have Nvidia, which is the AI beneficiary company, reporting its earnings. I've seen some analysts calling this the most important earnings report of the year, which is hyperbolic, but no doubt this will be an interesting new information point on what's happening with what is seeming like the current bubbly part of the market. Will a bell ring? I guess we'll see. I'm Daniel. This was the long and short of the markets. Thank you for watching. Subscribe to this channel. Check out middlecoastinvesting.com for written versions of this, and I will see you next week.